everybody's doing well. My name is Patrick Maffett. I'm the investment strategist here at Bear Wealth Management. And this quarter, we wanted to try something new where I'm going to summarize a little bit of the market commentary, because I know all of our clients out there read every last word of the commentary we get out. If you don't, then I wanted to just give you a brief synopsis here of the capital markets and how they performed over the first quarter here of 2014. So to jump into it, we are coming on the heels of a huge run up in the equity markets. Specifically in 2013, we saw a great year across stock markets. In the wake of that, we've seen quite a bit of volatility, really as of January, and then running up to the end of the first quarter. Markets got off to a rocky start. A lot of that had to do with some of these dynamics in emerging markets, which is it's definitely been a buzz phrase over the last few years. When we think about emerging markets, typically we talk about the acronym BRIC. That's BRIC, and that stands for Brazil, Russia, India, China. So we know what's going on in the headlines with Russia here of late. Of course, they're annexing the Crimean Peninsula, and they still look poised for additional military action in Ukraine. Well, that has dragged down Russian markets in the first quarter, at least, down about 15%. Moving on to some other emerging markets, Brazil, they're hosting the World Cup. For all you soccer fans out there, you probably already know that. They'll be hosting that coming in June, and it appears like they are woefully underprepared for that. And a lot of that has to do with the slowdown in their domestic economy. You can tie that to a slowdown in China and reduced commodity demand, which really bolsters both those economies, and namely bolsters the bulk of the emerging market economies as well. That slowdown in China is somewhat worrisome. A lot of strategists are pointing to the possibility of a hard landing there, which could result in ripples throughout the financial markets. As far as what our domestic equity markets did, the S&P was up 1.8% over the first quarter after a very rocky start. The major indices outside of the S&P were basically flat. The Dow Jones was down about 0.2%, and the NASDAQ was only up 0.8%. So tying it back to the S&P 500, right now we're trading at about 15 times the next 12 months earnings, which is a pretty widely watched gauge as far as valuation in the market and if stocks have run their course or not. That is pretty well in line with with the averages, slightly above the general average of about 13 times. Moving over to some more international equity. Back to one of these acronyms I like to use, and this one is PIGS, and that stands for Portugal, Ireland, Italy, Greece, and Spain. So a lot of those markets that were beaten up, you probably remember a few years ago, this European debt crisis. Well, that has not been completely alleviated or solved by any stretch. A lot of those markets actually rallied in the first quarter to the tune of double-digit gains. So that's another piece of what we would call developed markets as opposed to emerging markets that absolutely rallied. Things look pretty good in some of those periphery countries. In Europe, there's a lot of reasons for that. We won't jump into all of them. Want to move over to fixed income, and if you follow our commentaries, you know that at the end of the fourth quarter, throughout all of 2013 for that matter, fixed income had basically the wildest ride it's had in about 30 years. So if you recall, looking backward, bonds have been in about a 30-year bull market run. Last May through June, we saw about 100 basis point or 1 percentage point move in the underlying benchmark rates. Doesn't sound like much, but when you go from 1.6% to 2.6%, that's a pretty substantial move in interest rates. And of course, bond prices move inversely to interest rates. So we saw actually last year some of the biggest bond fund managers in the world down 7 or 8% over that same time period, and then the outflows associated with it. Well, what we've seen really in the first quarter has been a rally across fixed income to the same tune as the gains in the S&P 500. So the Barclays fixed income aggregate index is up about 1.8%. We have turned favorable on municipal bonds as part of our model portfolios. We did that in December. Our municipal bonds rallied about the tune of about 3.3% over the first quarter. All of that said, to kind of put a bow on this, I mean, it's the combination of the asset classes that I've talked about and how we build our model portfolios that seeks to reduce risk over the long run. So without jumping into the portfolio statistics or any of the academic theory behind it, the basic gist of it is combining asset classes Most of our portfolios use about a dozen different positions, and in seeking to attain a combination that's going to keep an expected return as high as possible given a level of risk. And of course that's specific to you as the client, whether you're an individual, institution, trust, whatever the case may be. So that's a rundown of the capital markets as they perform over the first quarter. If you have any question about our portfolio management approach, just about any of the model portfolios we run, or any questions specific to accounts that you may have with us, always feel free to reach out to our firm. Our number, of course, 770-984-2312. You can reach out to me directly or any of the other partners here. We appreciate you tuning in, and stay tuned for next quarter's commentary.